we knew tariffs would have an impact, but was the impact expected to be this large?
No, and that's even by the admission of Fed Chair Jerome Powell. He was asked today at a media event, and he even admitted that the scope of these tariffs is broader and deeper than many had expected. And that's really what the market sell off was all about. I know it's upsetting and surprising. I would, though, stress to the average person that market ups and downs are normal. We want to stay the course with our investments. This is not the time to panic and sell everything. Yes, disconcerting headlines, but we've been here before. The market will bounce back.
Yeah, and obviously that's something that I think we've all had to navigate because definitely it's also a good time to reassess as well. Because maybe some people kind of put that money away and maybe don't look at it often, but maybe now is a natural time to reassess and maybe see where you're losing versus where you're gaining. And so, what advice could you give in terms of that?
It's definitely a good time to reassess. I mean, especially if this is causing you some heartburn or some sleepless nights. Maybe you're invested in a way that's perhaps a little bit too risky, or maybe you just need a reminder. Sometimes people even talk about having some sort of investing mission statement, or maybe it's something you talk about with your financial advisor if you have one, or your spouse, or your parents, or somebody else that you trust, and just sort of level set here that yes, it's been surprising that the market's down 10% this week. That's basically back to where it was last summer. I mean, I know that doesn't sound great, but also sometimes it's darkest before the dawn. Markets can jump back up quickly. You don't want to time the market. The best predictor of investment returns historically has been time in the market, as in you want to start early. I mean, gosh, if you're in your 20s, every dollar you invest could be $50 by the time you
Right.
retire. And you have time to ride out those ups and downs. If life circumstances have changed, if you're trying to use some of this money to buy a house in the next year or two, or your kid's going to college in the next year or two, that's money that you want to dial back the risk on. Or for older people that may be getting close to retirement, these are times that we want to dial back our risk. But if you're a long-term investor, there's also the school of thought that says buy low, sell high. And when things are on sale, you can reap the benefits in the future. So, I don't want to whistle past the graveyard and say like, oh, nothing to see here. I mean, this has been significant, but I also think that we have to put it in a little context of these pullbacks happen and you just want to ride them out.
I heard an analyst earlier make a very interesting point, which was that you have those really overvalued tech stocks, those ones that we've seen perform incredibly well in these past few years, where maybe that barrier to entry was too high. And we're seeing now that some of those stocks have gone down in price. Would you say now is a good time to enter and kind of buy the dip, as people say?
This may have been a market looking for a pullback in a way. I mean, the tariff stuff has been pretty dramatic, but there is a school of thought that some of this may have been a bit frothy and overbought, especially those Magnificent Seven tech stocks. It could be a buying opportunity, assuming that you've checked those boxes as far as you're in it for the long haul, you're taking an appropriate amount of risk. I mean, not that we're even in a recession yet. I know some people dread that R word, but some people say that recessions are garage sales for the rich. I mean, things are on sale, and so much in our daily lives. We want to get a deal on Amazon. We want to get a deal on Best Buy, and then when it comes to stocks, when things go down, we don't view it the same way. I mean,
Right.
again, not to make light of the situation, but there can be an opportunity here where ultimately what you want to do is invest for the long term, keep your fees low, buy low, sell high. Some of these pullbacks do represent a buying opportunity. I wonder if we may see some of that next week too, because a lot of times the worst days on Wall Street are followed by some of the best. It's hard to jump in and out as an everyday investor. I mean, timing the market is very difficult, so that's where riding it out makes sense. But buying the dip can actually be a favorable part of market timing in a way.
The one thing I did notice was that those regional bank stocks were pretty hurt. Bank stocks in general are hurt by this, but you see regional banks, maybe in Northwest Ohio, like a Huntington, they were definitely hit pretty hard by this. Is there anything specific that would cause banks to be affected in the way they are? Because obviously, people, when they're not spending as much money, that's not a good sign for a bank.
Right, you're on the right track there. A few of the common threads would be anything viewed as riskier is going to sell off more in a time like this. So a regional bank would be riskier than, say, a Chase or a Wells Fargo or a Citi. There's also that consumer spending piece. And we've seen that with even very established payments brands like American Express was down 10% this week. And I mean, American Express is a great business that has a very affluent, stable customer base, but they get caught up in this because there's worries that people are going to spend less and there's worries that people are going to fall behind on their bills. I mean, that's less of a concern for the Amexes of the world, probably more of a concern like for some of those buy now, pay later companies. I saw that Affirm was down 22% this week. I mean, fintechs are riskier than the more established players. But there's been a lot of carnage across the board, unfortunately, on Wall Street this week. But again, important to take the long view, make sure that, I love that Warren Buffett saying about when you're buying a stock, think about what if you didn't open your app or web browser for the next 6 months? And, does that thesis still hold? Are you buying something that you think is going to succeed in the long term? And if you didn't look at it for 6 months, would you still like it? That's good advice.
Yeah, and obviously the other thing is that consumer spending component that you mentioned, because tariffs definitely can play a role in that. When things get more expensive, there is that desire to pull back. I've even experienced that this week where I may not want to spend as much on coffee or food or going out as much because of the uncertainty of how more expensive things are going to get. And so what advice would you give to the consumer who's trying to avoid tariffs but is maybe too anxious about how high prices could get?
This to me is the most significant part of the tariff announcement, the higher prices. I feel like I've been trying to find the silver linings with investments. There's no beating around the bush with higher prices, though. Unfortunately, tariffs are going to lead to higher prices. And that's hard for households to hear because, as you know, we've been dealing with high prices the last several years. And we've seen a big jump in terms of the cost of just about everything. And a lot of that went back to the pandemic and the supply chain disruptions. And the fact that the dust hasn't really settled on that, and now you're talking about higher costs. The Yale Budget Lab, for example, says that the average American household could face $3,800 higher costs over the
Wow.
course of a year. People don't want to hear that. We feel like rent is already too high, car insurance, groceries, everything. So, that is significant at the household level. And it could be significant for the economy if people pull back and they say, well, I'm either not going to go on vacation or I'm going to pick a cheaper vacation, or I'm not going to go out to eat as much, or I'm going to postpone that car purchase or that kitchen renovation. Or these are the kind of things that filter through to the economy as well as the kitchen table. And this is why the recession odds have gone up. Like JP Morgan Chase now says there's a 60% chance of a recession this year. It's because of the consumer spending pullback aspect of
And
this.
consumer spending was carrying the economy after a certain point, because that was what actually got us out of the COVID dip, was the fact that people kept spending money. And when people aren't spending money, that obviously is kind of like a domino effect in which you see that maybe some jobs have to be cut because there isn't that customer base at some companies. And so that anxiety certainly exists. And if this were to be the case that we head into a recession, we hope not, but what can be the best thing that you can do now in the case that we're heading down that road?
I come back to those fundamentals, things like boosting your savings, paying off high cost debt, especially credit card debt, taking the long view with investments. You mentioned the job market. There's some interesting things going on there. Obviously, negative headlines on the face of it when you think about all the federal layoffs and other sectors too, tech, media, retail. There have been some downbeat headlines, federal jobs most of all. The job firm Challenger Gray and Christmas said that last month was the worst month for job cuts since the pandemic, and actually the third worst month dating back to 1989. I mean, that definitely gets your attention. Then again, though, at the risk of sounding too positive, the March jobs numbers came in today and they were surprisingly good. Now, it's kind of
Right.
hard to square those things. A couple things could be going on. One is there's a lag. I mean, we do have to be mindful of the lag to some of this data reporting. But the other thing, though, is that it does seem that people are finding new jobs pretty quickly. So that's a good thing. And part of what the administration's trying to do here is to create a bit of a shift. So a shift from public sector spending and employment to more private investment. that's part of the tariff thing. They're trying to have more factories, more manufacturing in America. Now, some are skeptical because they say, well, hey, we love our American companies, but it's expensive to make things here and buy those products. And many people are critical of how this is upending longstanding trade agreements. But I feel like the positive spin from the administration, at least, would be buy American, wait this out. There's going to be a little volatility in the near term, but they say in the long run, this could lead to better paying jobs, lower taxes. That's an interesting part of this. If you also spin some of this forward, that if the government's borrowing costs come down because long-term investment or bond rates are coming down, can tax rates come down in an ideal world? And this is really spinning it forward, but President Trump has talked about, could we do away with the income tax, replace it with tariffs? That seems like a stretch, but at the very least, some of this may be the foundation for tax cuts that we already know are going to be proposed in Congress this year.
Yeah. And there is that other part of this too, because there is this desire to build everything, make everything in America. But there's the other part that people may not realize, which is that the labor costs will go up and therefore the price of items could go up. And so could you maybe expand on that? Because on the surface and in writing, the idea of making things here in America sounds good, but it could mean that your iPhone could get more expensive or your shoes could get more expensive.
Right. This is one of these cases where, as workers, we love to get paid more, but as consumers, we don't want to have to pay more
That
for
is
things.
correct.
I am skeptical of this manufacturing component just because I don't think we're going back to a world where manufacturing is the US's top industry. I mean, I feel like that's going back a ways. Like we've become much more of a services driven economy, whether that's business and professional services or technology or media, healthcare. Services really power the US economy and actually most industrialized economies. So, could we maybe stand to have some more US manufacturing? I mean, yeah, and that is a big part of the president's base. But this is where I feel like the tariff plan is a bit misguided in that I just don't know if it's quite as simple as buy American, make American. I mean, you also can't be a business and snap your fingers and all of a sudden spin up a factory with all this equipment and all these workers. And, a lot of this stuff is playing out in real time. And that's difficult for businesses to make adjustments. It's difficult for consumers. I don't think there's going to be a ton of patience here from consumers. Like if these prices really do go up as much and as fast as people say, I have to think there's going to be pushback there.
Yeah, that's definitely inflation is an issue that voters do not like. People do not generally like when things get expensive because even when you go somewhere and your thing went up a 30-cent surcharge, I mean, that is something that will bug people for sure. But the last thing I want to get your thoughts on is obviously what we got news out of China today. It was that they're going to put a 34% tariff on the US exports to China. And so what impact could that have here at home?
Well, this is what economists are worried about with this trade war kind of spiral of this sort of tit for tat. I mean, the president already talked about this week the retaliatory tariffs, and he was talking about how all these new plans are basically just to address existing imbalances. And if a country is tariffing us 50%, now he wants to do half of that, 25 on them. But then they may retaliate with their own. So, then we're sort of layering just things on top. And China's a huge manufacturer. I mean, we source a ton of products from there. And yeah, this is kind of what people are afraid of. That's why today's stock market drop was worse than yesterday's, because the initial drop was enough, but then you have the retaliation from China, and then it's just like, well, all right, how's that going to play out? I mean, that's going to be higher prices up and down the supply chain. And what if other countries do the same? And that's kind of the uncertainty game that Wall Street is playing now. Investors don't like uncertainty. Businesses don't like uncertainty. That's what's driving a lot of the news of the day or news of the week.
That's definitely the word of the last few weeks, uncertainty. I feel like that should be the word of the year at this point. If we stay down this road, that will definitely be for the end of the year. But I want to thank you so much for joining me, Bankrate Senior Industry Analyst Ted Rossman.
Thanks for having me on.
Thank you. You have a great weekend.
All right, thanks so much. You too.